You were deep in something, but I was distracted by trying to cut you off. So please
Well,
continue your thought.
what was I saying?
We
I
were
was
talking
saying about
about you were saying we were talking about inflation potentially being a backward leaning, but like it's TBD, and you have some people saying look at things like ISM manufacturing that could be problems ahead. You think this is we're shifting direction on the fiscal front and we're digging out, um, and then you were
yeah,
building on that point from there.
yeah. I just think that we're a little bloated as a country. Like, we just are, right? We're in that weight shedding phase. And I think that that needs to take time to phase out. It's not going to happen in a flip of a switch. Like, this is 1 month, maybe 2 months. No, it's actually just really a couple weeks of policy changes. Literally only a couple weeks. We move as a country very slowly. Like, it takes a long time to phase things out or feel those impacts. That's why I think we have more time to kind of feel this pain and feel this burn. And this aligned with like the indices are still below massive levels. Like, I just think that yeah, we're up today, but like I do think there's gonna be some. A lot of people were expecting a bounce because of that daily RSI oversold nature. I think there's gonna be some profit taking. I don't think this is going to be like a V-shaped recovery environment to get above those technical levels to a new all-time high. I don't think that's gonna occur. I hope I'm wrong because again, I'm invested, guys, just like all of you. I'm just being defensive where I'm trimming today, like to raise capital. I think I want to have an 8 to 10% cash position to wait for the capitulation bottom when VIX is 35 to 40. You feel that everyone just is really tight and on FinTwit and very aggressive, and you're seeing like headlines on legacy media outlets like is the bear market is are we gonna hit a bear market? Is the glory days behind us, dead 20s. Like, we haven't gotten any of that. This was somewhat of a control pullback. So, like, I think there's going to be more a newer lower low, and I want to be prepared for that.
Yeah, I think I saw a bunch of people having like, did CNBC put up their markets in turmoil graphic yet? Because they love to do that. You know, cable news, you got to fill in 24 hours a day, so you gotta something's got to be going on all the time, and even worse on social media. Um, let's zoom in a bit. I know you tweeted this morning about some big news out of on the nuclear energy front, and this is something we had talked about when Robert Croak was on. But looks like some of the major tech platforms are banding together and making a commitment to produce more nuclear energy. What is like your takeaway from that from an investor point of view, Shy?
Yeah, so I think the common theme this cycle from big tech was we're compute and energy constrained on. That's why our AI workloads were somewhat lighter than expected. The demand is there. It's just we weren't able to fulfill that demand because of these constraint issues. I think that's why they're treating this whole year as an investment year where we're going to have heavy capex. We're not going to see the reacceleration on the top line to match that incremental bump on the capex spend, but that's okay. We need to kind of we're in that middle of that S curve for AI, and they're treating the middle part as we're going to get all the tools necessary to finally hit our max AI potential. Alternative energy is a necessary component of AI hitting this max potential. You just absolutely need alternative energy, specifically nuclear, so you don't have that energy constraint issue going forward. Because guess what? AI is not a fleeting moment. It's a structural change that's going to be in our lives permanently, forever. And nobody really knows the ceiling on AI. So I think they're preparing for let's just get all the tools necessary so we don't have this energy constraint issue every single year. That's what I see. And it also takes time to play out. Like plants, it takes half a decade to put up plants, minimum. So when you say 2050, like if you want to triple the global nuclear power capacity, you know how many plants that is required to do so? It's substantial. So you can't just do them all at once. Like there isn't an avenue to do that. So like they have to phase it out and do it in stages. And that's why I think like the 25-year timeline, like it makes sense. And it is something that is somewhat delicate because Chernobyl, come on, we can't have another Chernobyl. So like you work with your enemies a bit on trying to get as much nuclear energy online without risking the world, and they're going to work together, and they all need this for their AI workload. So let's let the AI product speak for itself. But let's all work together to get the alternative energy to a place where we can all succeed. I think that's what's occurring right now.
It's nice to see people working together collaboratively. We love to see that in the markets and in the world. Some fresh data just dropped from the housing market. So it looks like weekly mortgage demand is 11% higher, and interest rates dropped for the sixth straight week. We obviously had the big news come out of Redfin and Rocket companies earlier in the week. Shai, what do you make of this update? Is this anything that investors should be paying attention to? Is it something that was expected? How are you feeling about the real estate housing market overall?
I think it's expected because rates are going lower. It's been a hot minute since that's really happened. But I don't know. Like, I know so many. Like, for you to leave your 3% interest rate house to move somewhere where you're gonna get 6%, it needs to be somewhere. Like, it needs to be a substantial reason on why you're doing that, and there really isn't one out there. Like, if that's why I think like Home Depot and Lowe's, like they did so well because recently in the past year or 2 years, or you're seeing that right now, where uh, homeowners get bored, and if they can't move out because the interest rate environment, like they're gonna make their current home dope as f, dope as fuck. Oh my god, I mean I meant dope AF. And I I think that like mortgage these mortgage applications, I think it's for like the newer homeowners, like the past 2 years,
Yeah.
like maybe they just want to get lower rate, but I don't think it's gonna be anything structurally different until we get those rates closer to 4%, if that.
Yeah, the renovations are interesting because you're right. The trends were in the favor of renovations, but then the Wall Street Journal had a report come out talking about some of these stocks that are signaling major renos. So like doors, windows, water heaters, plywood. They've been dropping actually. So it's like there maybe it's people are doing some DIY things on like the Home Depot Lowe's front, but maybe not adding a wing or something. But it's always interesting to watch those tangential companies that are signals of the bigger story at play. I want to flip to earnings today. Anything you're spotting or looking forward to? I know we have Adobe, we have SentinelOne. Anything you're looking out for, Shy?
Yeah, so SentinelOne, definitely catching my eye. It's a cybersecurity play. It's the little cousin to CrowdStrike in the endpoint security space. I think I was I was so annoyed last summer because like it was nauseating the narrative after the outage for CrowdStrike. Like, oh, this is SentinelOne's time to shine. Like they're gonna start eating up all of CrowdStrike's business. And during that time, it's like when I realized when people like folks were talking about this on Twitter, it's like you actually don't know what you're talking about. Like now I know. Like you revealed your
That's when you
cards to me.
realize people don't know what they're talking
Well,
about
no, these
on Twitter.
gurus on Fin Twitter, like they're pitching Central One so hard, saying
Yeah.
this is going to be bigger than CrowdStrike in a year or two. CrowdStrike might go um, like under $100, maybe even zero. I'm like, you guys actually don't know what you're talking about. And now
Yeah.
I just unfollow them, mute them, whatever it might be. But you're all BS. Look at Central One's price action right now at $19 pre-outage. What was it? They were at $22 in July 19th. Let's see, where was it? In 2024. 2024, I think, yeah, they're 20, $23. So they're essentially 20% lower before CrowdStrike's outage. I think CrowdStrike is at this is actually higher right now. No, CrowdStrike is essentially where they were before. So CrowdStrike somehow V-shape recovered, and SentinelOne just like did is lower than they were pre-outage. I think that just symbolizes how much of a high quality product the Falcon platform is for CrowdStrike, and SentinelOne is just a very tier two play. SentinelOne is always they have a great product, they have great metrics. It's just they've also had a CrowdStrike issue where like why aren't you growing more than CrowdStrike when CrowdStrike has these margins in your smaller scale? Like you should be outgrowing them, and you have less margins than them. Like it doesn't make sense on why that is. It's because the product speaks for itself. So like I think a lot of folks were hoping that the outage finally eliminated that CrowdStrike problem SentinelOne had, and their product could speak for itself, but they couldn't capitalize on that. CrowdStrike had minimal churn, like 97% retention after that outage. SentinelOne barely got a bump from that. And I think SentinelOne's just going to go the same route as every tier 2 to tier 3 player in software, where consolidation is going to occur and they're going to get acquired by someone bigger. And Microsoft probably, like a big tech player like Microsoft maybe acquires them, but like I just don't think they're going to be a standalone product in a couple of years. I don't. I think it's going to be Palo Alto and CrowdStrike is a clear tier, and Zscaler is a clear tier 1 plays.
Yeah, I mean, those conversations almost reminiscent of the whole like delete Uber movement where everyone's like, this is Lyft's time. And it's like, okay, that didn't happen. But I think people's attention spans and their memories are very short these days. So to your point, it didn't completely crush their business, and a lot of people were talking about them. So looking forward to seeing that report coming later today. As we wait for the opening bell in the back half of this show today, we have a special guest. He will be coming on after the opening bell, but it's Charles Gillespie, co-founder and CEO of gambling.com. We are going to get all into the online gaming and betting landscape, which is pretty dynamic. Shay, are you in the mix, online betting, gambling? Are you sticking to the markets?
I used to be a degenerate, if that's what you're asking. But then my fiance was like, I can't have you doing that, because like I was just like, every game I was watching on TV, I had to have some kind of cheddar involved, and I just like it got to a point where I cared more about like my spreads and my over unders, and it was just like my chest couldn't handle anymore, and I was like, I'm 31 years old, maybe I should call it quits.
That's the thing that's sad now. You go to a sports bar, no one's rooting for teams; they're rooting for like specific things to happen. And it's like no one even has any loyalty anymore. It's just like, oh man, I hope like he misses this free throw, so I hit my parlay, even though they're like wearing a Duke jersey and like Duke's about to lose or something. It's just like it doesn't make any sense.
It used to be so bad for me where I used to hedge my feelings all the time. A massive Clipper fan, massive Ram fan, massive Dodger fan. If there's a big game, I always bet against other teams. So if they lose, at least I made some money doing so. Like that's what I mean by hedging my feelings. So it was getting to that level.
Yeah, I had a little stint online gambling. I got DraftKings Sportsbook for the first time. I like kid you not, I hit like a 4-leg parlay, like a $5, and I was like, I think I'm just smarter than everyone. And then and then I went to Notre Dame, so I didn't hedge my feelings, and I bet a lot on that one, and I was like, you know what, I'm going all in, and then I deleted the app. It's not for me, but it's big business. It is huge business. It is impossible to go anywhere without seeing anyone doing anything of the sort related to sports. But also, you have Polymarket now. You have other things going on. So I'm really excited to talk to Charles and see what he's up to over there. And there's our opening bell. Shay, I know you gotta boogie and make some moves, but we'll see you bright and early tomorrow morning.
See you guys.
Okay, and we're waiting for Charles Gillespie. Hello, Charles. How are you?
I'm good, Katie. How are you?
Good. We were just talking basketball. You're from North Carolina, right? Who's your affiliation?
Yeah, I went to UNC. Graduated in 2006, and yeah, not the best season for the Tar Heels on the hardwood this year, but we'll be back.
You've had some good runs though. Like
we won the national championship when I was there in 2005, so very good fun.
Yeah, I'm from Syracuse, New York, so basically my entire childhood was determined by if the basketball team was good, which it was one year when we had Carmelo Anthony, and now we're fighting for our lives. But it's so good to see you, and we're excited to talk to you about everything you're working on over at gambling.com. It's Gambling Group. GAMB is the ticker. To start, let's give everyone watching a quick intro, because there's a lot of players in this space, and you guys are fit within a specific pocket on the affiliate side. Affiliate's a word that if you're in marketing media world, you're probably familiar with, but if not, you might not be. Can you break down what that looks like and what that means in terms of how you all make revenue within this landscape?
Sure. So listeners may be familiar with the affiliate model in other industries, right? You know, if you go to, I don't know, hotels.com to book a hotel and you end up booking a hotel in Paris, you know, they're going to get paid something for facilitating that. There's many examples out there, you know, Lending Tree for mortgages, and that's what we do for the online gambling industry. So we actually don't book the bets ourselves. We're actually not directly in the business of online gambling, but we help all the online gambling companies you have ever heard of acquire new customers by sending them traffic. We've got over 50 different websites. The flagship is, of course, gambling.com. And on these websites, we'll give bettors, whether they're brand new bettors or experienced bettors, all the information they would ever want. So, you know, odds, bonus offers, promotions, you name it, it's all there, whether it's sports betting, online casino, bingo, you name it. And, we'll help people find the best place for whatever it is they're looking for. Maybe they're very into betting on the NBA. Maybe they're very into a certain online slot. You know, whatever their preferences are, we'll help them find the best place to play. And naturally, we get paid by the online gambling companies for facilitating that introduction.
Yeah, and I know you guys are 50 websites, more than 10 languages, 19 national markets. And so it sounds like you're sort of in the value chain of online gambling, but you're not going up against a Flutter or DraftKings. You're enabling those platforms. So as the category grows, you're a part of that. Is that a correct way to think about it?
That's it. Yeah. So Flutter and DraftKings are clients, and you know, as much as they grow and succeed, it helps us and everyone else in the sector. A lot of things something we hear frequently from our investors is it's nice to invest in gambling.com because we're going to benefit regardless of who ends up at the top of the pile at the end of all this in 10 or 20 years, right? So whether it's DK, FanDuel, or somebody we've never even heard of yet, gambling.com and the picks and shovels plays in the space are going to benefit no matter who it is.
I want to go back to sort of the journey of the company, because I heard that you and Kevin actually took significant personal sacrifices as you were building this, including living on a very, very low salary for your level to kind of keep things running. Can you tell us what that was like navigating those uncertain times? I know in the regulatory environment it could be sort of unpredictable. How did that shape the way you lead the company today?
Well, it certainly keeps you humble. This was not an overnight success. Kevin McChrystal's the co-founder of the business with me. We both went to UNC. We both actually grew up in Charlotte. And when we wanted to start this company, there was no regulated online gambling in the United States. So we had to leave to build the business. And we ended up building the business mainly in Europe and on the back of the UK market with a big office in Ireland. And for the first 6-7 years, we thought we were doing everything right, and we had to make a few kind of pivots and changes here and there. But we were young, naive, and very ambitious, and thought we would obviously figure this out and make a lot of money. But for the first 6 or 7 years, we didn't figure it out. It took a couple of at-bats to get some wood on the ball, but by kind of 2014, 15, we kind of got our model together, and we started to see very consistent growth from that point on. But it took a while, and there were definitely hard moments of introspection and hard questions asked about, are we actually any good at this? And we took a very long-term view. I think a lot of the other people in the space, they just kind of went straight at the money. If there was gray markets, dark markets, they kind of went there first and didn't overcomplicate the technology, whereas we had this kind of American view on it. We were like, okay, if we want to be the world's best at this, it's not about running one website, it's about running a big portfolio of websites. And that requires certain technology investments. You can't, if you want to run one WordPress site, okay, it's not hard. But if you want to run 50 of them and find economies of scale in ad tech and content management and all the other stuff that goes into these sites, you actually need to invest some money in it and some thought and time. And we kind of started on that, and maybe we were a little too long-term focused at the beginning, but eventually those investments started to pay off, and that's when growth really took off.
Yeah, and given the breadth of coverage you have across all of these sites, you must see a lot of data and just pick up on trends happening, not only just from a engagement standpoint of visitors and gamers, but also just the content itself that's flowing through the system. What would you say some of the biggest trends were in your space in 2024? I know we've heard about kind of the AI personalization angle on gaming and betting. Are there things that really bubbled up that you saw given your purview across all of these sites?
In the US, this same game parlay product from the operators has really taken off. Parlays are nothing new, but the ability to do a parlay with multiple, say, player props within the same event is relatively new. And the operators love it because it's a high margin product, right? The way they do the math on those products, they hold a substantial proportion of the money, which is bet. But customers also love it as well because it's like a little mini lottery ticket. If you've only got, I don't know, $20 in your account, doubling it to $40 is great. But some people want to do a 10-leg same game parlay. It's probably not going to hit, but if it does hit, you might make 10 grand or 100 grand, right? It's a very different kind of entertainment product, and people love it. So it's been really growing in the U.S. market, and it's something that we're investing more in to help people, compare those and build those and understand those better.
I have seen that behavior pick up anecdotally amongst my peer groups, and I've personally thrown $5 on a crazy parlay just to see. You never know, especially here in New York when you can justify it and say, well, this is what a cup of coffee costs. So I wanted to
say it's entertainment, whether
Yeah.
you go buy a movie ticket, a cocktail, or anything else. It's just entertainment.
Yeah, and I was talking to Shay before. I'm not personally like a gambler at all, but when I'm doing this, I am so engaged into everything that's happening within the game. It's a different experience than just being a fan, and that I didn't realize that until I had started actually dabbling myself, where I was like, okay, this is very different. This is a
Don't
different
bet against
feeling.
the home team.
Yeah. I want to talk about, speaking of home teams, let's go to North America. Online sports betting market in North America obviously showing some strong momentum, but there's also some headwinds too on the regulatory side. Missouri is expected to launch sports betting in 2025. I know we're waiting on some other states to follow suit. In your space, you can control what you can control, right? You all have your plan and your vision, and then you have this whole other beast of policy. How do you balance those things and kind of work with the policymakers as you're building a business to expand beyond where we're at today?
Well, as a public company, the first thing we learned was don't put new state launch revenue in your guidance until you know absolutely clearly when the new state is going to launch. So in the case of Missouri, for example, it's almost certainly going to launch second half of this year, but we don't know exactly when, so it's not in our guidance, and it won't go into the guidance until we know when, because if it falls in Q3 or Q4, obviously makes a difference that we need to manage the street. But more broadly speaking, there's a huge one-way trend here. The United States 10 years ago got regulated online casino in New Jersey, and that was the first. And then they took the court case to the Supreme Court and won for sports betting, and then they got sports betting, and then all these other states have followed suit. It's the expansion of regulated gambling in the United States is very clearly going only in one direction, and it may happen in fits and starts. You may have a year where you get a bunch of states that regulate. You may have a year where you only get one state that regulates. But the long-term trend is crystal clear. This year we've got our eyes on Texas for sports betting. Also, New York has got a decent chance for regulating iGaming. And from the industry's perspective, iGaming is worth a whole hell of a lot more than sports betting. Sports betting's the mass market product that everybody sees, and it's got a kind of broader appeal. But if you just look at the unit economics, the casino business is a better business than sports betting. Sports betting actually is kind of a low margin business. You need an enormous number of sports bettors to make a nice business out of that, and that's why FanDuel and DraftKings have kind of separated themselves from the pack a bit, because they have this huge scale. Whereas on the online casino side, iGaming side, you can have a relatively small upstart online casino that's profitable, because they don't need the same degree of scale. So anyways, with iGaming, you get better unit economics, and you get a lot of more investment coming into the space, because you don't have to be supersized to be profitable.
Yeah, it's great you brought that up, because that's not one you see when you're at a sports bar and you look at someone's phone necessarily. But you're saying it's bigger, and I'm curious how your portfolio at gambling.com, how is that weighted in terms of sites that cater to sports betting versus iGaming? How do you view that mix?
We call ourselves a iGaming first company. It's because it's a better business model, we pursue that as a priority. Now, having said that, the wave of regulation in the United States over the last couple of years has been predominantly around sports betting. So we've taken that opportunity extremely seriously, and we've grown our North American revenue from a couple of $1 million to 60 million, I think, in 2023, and we haven't yet reported the granular numbers for 2025. We've only done the pre-release, but that's coming in next week. So it's a huge proportion of our business, and we wanted to take sports betting in the U.S. very seriously, because we see it as the kind of gateway to the broader regulation of iGaming in the United States. And that's why we own bookies.com. That's why we bought rotowire.com. That's why we bought OddsJam at the end of last year, which is a phenomenal product. These guys are absolutely cracked developers, incredibly talented team, which has built an engine to process the odds data from all the different operators around the world, not just in the US. And they do it at a super low latency way with advanced modern technology. So those updates on when a sportsbook changes their odds make it all the way to the end user on their app they measure that in milliseconds. And that's critical if you're trying to take advantage of some of these mispricings or arbitrage plays or what have you. But so that business we bought end of last year, and that's obviously it's a little bit different than an affiliate business. It's a subscription business where consumers pay roughly $200 a month for access to that kind of gold standard odds data. We think it's the best that exists, and there's a huge amount more we can do with that company in the future. Once you have access to that odds data and platform, sky's the limit. I mean, there's all sorts of really interesting things you can do, and other services we can sell to our online gambling operator clients. So that one's very exciting. But yeah, we're on the marketing side of the business, iGaming first, but there's been no shortage of opportunity and kind of strategic value in taking American sports betting seriously, and that's what we've done over the last few years.
And on the M&A front, two things. One, are these sites constantly popping up and you guys constantly monitoring opportunities to acquire new properties? A, and then B, the business model of the last site you mentioned being subscription is interesting, given I know it's off of what you normally do. Normally you're doing the affiliate and that's ad revenue, so free audiences. Are you looking to acquire more subscription like businesses, or was that a unique opportunity that you saw?
So the only problem with the online gambling affiliate business, it's an incredible business. It's highly profitable, it's high growth, it's relatively reliable. The only problem is it's got a little bit of volatility. You got volatility from whatever, side of the bed Google wakes up in the morning. It's gambling. Sometimes people win, right? So you have these commercial relationships, revenue share accounts. Sometimes you get paid a lot, sometimes you get paid a little on the same account. So, as a public company, that volatility is a little annoying. We need to manage the business quarter to quarter. And we love these subscription businesses because it's the exact same end users as our affiliate websites. And it's highly predictable. We can forecast it with great precision because you just look at the trend lines and the churn rates and everything else. So we do really like these subscription revenue businesses, and we would be very happy to look at others as they come up. You first asked about affiliate sites kind of popping up. Are we constantly seeing newcomers enter the space? We've been doing this nearly 20 years, and that was absolutely the case 10 years ago. I think the industry is really consolidated. It's harder to compete now. We've got 600 people, and we've got tens of millions we've invested in our technology to run these sites. We've got, a link profile and brand names and domain names you can't imagine. I mean, we own casinos.com, plus gambling.com, plus bookies.com, plus, we own scores.com, and it's just sitting on the shelf gathering dust because we've got too many other, interesting projects before we can even get to that one. So 10 years ago, yeah, you saw these kind of sites popping up, but now it's not our first target. We're not from an M&A perspective, top of the priority list is not going out to buy more online gambling affiliate sites. Although, when the right ones pop up at the right price, we're happy to take a look at it.
I did want to ask, because you brought it up on the domain, because that's a big thing now. Like in branding, a lot of startups are dropping a lot of their seed and A funding on domains. Do you remember what you paid for that, or was there an interesting story about how you got gambling.com?
I will never forget. So we didn't start with gambling.com. We were in the right place at the right time in 2011. It was a distressed sale. The company that owned it before us was a UK listed company that they had a number of different assets, and they were running short on cash. Gambling.com's always been an affiliate site, and up until 2006, it was doing well in the US. For your industry savvy listeners, they'll remember that in 2006 there was this unlawful Internet Gambling Enforcement Act, which passed at the end of the congressional session at 11 o'clock on the very last day, which made the payments for online gambling illegal, without clarifying whether online gambling itself was illegal or not. But anyways, I digress. That was a pivotal moment in the history of the industry. And gambling.com before that was apparently doing very well. And these guys bought it for $20 million a couple of months before that. But after that legislation, it kind of, fell over, and they didn't really. There was an obvious opportunity to pivot it to the UK, which, is for a long time has been the world's biggest regulated online gambling market. Before the big American boom, and they just didn't do that. And by 2011, they needed to do a deal. They told the industry they were going to auction the domain name, and they said the reserve price is, I think, $9 million, and nobody bid because it wasn't worth $9 million at the time. And they started kind of ringing around the industry trying to get some last minute bids in because they really needed money. And they said, look, put in a bid. You might get it for a lot less than you think. We pulled all the cushions off the sofa and found some cash and made them a bid of $2.5 million.
Wow. That's cheap for those people listening at home. That's very good.
Yeah. I mean, it's hard. It's impossible to say what it's worth today. It's like asking what's Google worth. It's inextricably linked with the value of the company, right? You just kind of value it separately. But yeah, our market cap's $500 million on a bad day now. So I think it worked out.
That's awesome. I love those backstories about the domains. I know we have a few minutes left. I want to shift to preliminary Q4 and fiscal year 2024 results. I know you pre-announced some of those. Revenue at $35.2 million for the quarter, $127.1 million for the full year. You voice over some of those results. What should investors, either in your company or potentially interested, what should they be paying attention to in this preliminary share out?
Yeah, I mean, 2024 feels like a long time ago now, so probably the most interesting bit of that press release was the guidance we introduced for 2025. Midpoint on revenue of 172 million and midpoint on EBITDA of 68 million. When we IPO'd this company in 2021, we had 42 million in revenue, and we IPO'd at 8. And now we're 4 years on. We're going to have 68. We expect to have 68 million at the midpoint in EBITDA this year, and the shares are at 12 odd or whatever it is. So, we've executed unbelievably well since taking the company public in the United States. I'm incredibly proud of our team, and hopefully at some point the share price will catch up.
Yeah. And I want to quickly touch on that because I know there was a lot of operational efficiencies that were unlocked that you talked about in that share out. At a high level, what do you credit the ability to kind of get those margins in a good place?
It may seem simple, but you just got to be able to say no to stuff. We see interesting opportunities all the time. Our internal team brings us interesting ideas. We get brokers bringing us interesting ideas, and you just have to say no to 99% of it. Otherwise, you won't have enough time, energy, and treasure to invest in the core business, which is actually paying all the bills. So focus and the ability to say no to stuff is critical.
All right, let's get your final thoughts because we've been jumping around a lot of trends and topics, acquisitions, expansions, geographic nuances. What do you think the biggest opportunity or challenge is for you guys in the coming year, say 12, 24 months, and how are you preparing for that?
I think the biggest opportunity, the answer to both questions is the same. So both the biggest opportunity and the biggest challenge is growing the B2B side of the odds business we bought at the end of the year. So the guys behind OddsJam, they at some point the operators started calling them up and saying, "Hey, look, this data is amazing. Can we buy it on a more kind of enterprise basis?" And it's not exactly the same. That it is packaged, different data packaged differently for different customers. But they started selling that data, and the operators love it. And they're mainly just selling that in the United States, whereas we have a global footprint. We've got offices all around the world, and we know hundreds of European operators. There's way more operators in Europe than there are in the United States because there's just more markets. It's more there's just more separate markets and every single market can have 50 plus operators. So we think that there's an enormous opportunity to sell that product to a bigger audience outside the United States.
All right, Charles, thank you so much for hopping on. Of course, we have Charles Gillespie, that's CEO, co-founder of Gambling Group, hearing about their humble beginnings to getting a great deal on the domain. It's been great spending time with you and going a little bit under the hood of GAMB.
Anytime, Katie.
And for everyone else, we will see you back here tomorrow. Shay will be returning with more hot takes on all of the craziness that's happening in the markets, and we'll see you soon. Okay.